Hi, sorry, because there's some personal family emergency, so I cannot hold a meeting at 3 o'clock in the mountain time. So what I'm doing right now is to record a section and I'll post it into eCampus is for you guys to watch. So for today, I wanted to quickly go through chapter 2 and maybe half parts of chapter 3. But before we move on to chapter 2, I have been walked through with your assignments you've submitted, not assignments, class exercises. There are a few questions. Mostly, you guys did a very good job. Only one little part thing is for, I think is the problem 1.2a. I ask you for analysis of the business transactions. So that is the one we actually went through in our natural one. So if you are still getting questions on that, you can go back to session 1 and watch the recordings. But that is actually also the Excel template I sent it out. Right, so you watch out for each transactions of the business transactions and put into this template. This template, it shows assets equals liability plus owner's equity. And in this, under the assets, you have cash, account receivable, supplies, land. Under liability, you have accounts payable, owner's equity, you have the capital. So for examples, our examples from the first lectures, it shows the owner invest $250,000 cash into the business. So in this table, it showed up our cash increase with $250,000 and our shareholders' equity increased $250,000. So that is how this form is being used for your practice in your exercises. Except for that, another question we're having is the equation. There are very important equations we need to remember is the assets equals liability plus owner's equity. But when you take a look at this one in detail, what other factors will affect your owner's equity? It's the owner's investment, the owner's withdrawal, and the owner's net income. The net income equals to revenue minus expenses. So by any chance, just give me 1 second quickly. So by any chance, when you see a question, they showed you, I think it's right here. They showed you the owner's equity at the beginning balance. They showed you owner's investment during the period. They showed you owner's withdrawal during the period. And also they gave you the ending balance of the owner's equity. They ask you what is the net income. So the owner's equity statement is the one that you need to pay attention to, right? As long as you already know the rest of the numbers, you just need to use a very simple mathematics to calculate the net income. So this is how it works. If you see those kind of questions to give you most of the numbers and ask you for net income, or they give you expenses, ask for revenue with all the rest of the numbers in the owner's equity statements. So this is another one. And the last one from chapter 1 is the, I think it's exercises 2 or 3. But anyway, they wanted you to do a journal entry. Not a journal entry, but they want you to have analysis before you put into the form. So this is the one. People are always got confused. The company sold land for $50,000 cash, which was the business cost of the land. What is the journal entry looks like? Your assets cash increases $50,000, right? And also not decrease. No, decrease will be the assets land. You will have assets increase with the cash $50,000. And also your assets decrease for $50,000 because of the land being sold. So this is how that works for this kind of business transaction. Most of people put debit with assets cash and credit with capital, owner's capital. We cannot see it's not correct, but the accounting for the sale of land differs from the accounting for the sale of any other type of fixed cap assets. Because there is no accumulated depreciation expenses, we're going to talk about accumulated depreciation a little bit in our chapter 3. Because land is not depreciated on the theory that the land is not consumed, of course. So this is in the case with other fixed assets. When you sell a land, debit the cash account for the amount of payment received from the buyer. Credit the land account to remove the amount of land from the general ledger. So that is how the accounting records when you sell a land. Unless the buyer pays you exactly what you pay for the land, there will also be a gain or loss on sale of the land. If the amount of cash paid to you is greater than the amount you recorded as a cost of the land, there is a gain. So the gain on the sale will record it as a credit. If the amount of cash paid to you is less than the amount you recorded as the cost of the land, there is a loss on the sale and you record it as a debit. So that is how the accounting dealing with the sale of land. Okay, that is also a very common mistakes I've been seeing from your assignments. Wait, I don't want to close it. So now we finished chapter 1's overview. Now we'll move on to chapter 2. We'll have to quickly go through chapter 2. What is chapter 2's major thing is talking about debit, credit. We introduce journal entries on concepts and for introduction of accounting, because journal entry is one of the most essential concepts that every accountant should be memorized. So when we keep moving on, we're going to quickly go through that. So learning object 1 of the 5, right? So there are 5 objectives for chapter 2. What are the key terms used when we record transactions? All account systems, including account, journal, ledger, trial balance. Account is a very basic component of accounting system. So we know that assets equals liability plus owner's equity, right? Ledger works as a banner. So each page in this banner representing one account. Okay, so when you organize all the account together, it becomes a journal. Then it becomes a ledger, sorry. And then the journal is introduced later in learning object 3. So we're going to see how we're going to record a business transaction. Accounting is based on following the 6 type of accounts. Now we already know that: assets, liability, capital, withdrawal, revenue, expenses. Okay, so we should have a very good understanding of each before we get to continue. Now, chart of account. Chart of account is a list of all the account by account number. Example is given in our exhibit 2-3, which is this one. We could see that the accounts are numbered beginning with assets, then liability, then owner's equity, and then revenue and expenses. Accounts in the ledger are always in the same order. So assets are normally started for 1,000, liability 200 or 2,000, owner's equity 300 or 3,000, revenue 400, 4,000, expenses 500 or 5,000. The fact that accounts of similar nature are grouped using similar numbers. So that many companies using these groupings is to help learning tips that might help you to identify the type of accounts when they find the title of the account confusing. Sometimes when you see a question to ask you to name or to match the number and account name. So you're looking for one is always, when the numbers start with one is always under assets, two is always under liability, three under owner's equity, four under revenue, five under expenses. Okay, so that's his chart of the account. Now we're moving to the learning object number 2, apply the rules of debit and credit. This double entry accounting rules is the most important rules you need to memorize because it's going to go with your whole life. Okay, double entry accounting records the dual effects of a business transaction. The dual effects of transaction can also be described as having a receiving side and a giving side. Each transaction affects at least 2 accounts. As we could see that you purchase supplies, you increase your assets with supplies, you decrease the cash because you spend the money. If you increase your assets, but you have on account, so you credit your account payable. If you increase, you sell the land for cash, you debit cash and credit, and decrease the assets, the cash, the land, I mean. So those are always being, 2 accounts has been affected by 1 business transaction. Now we move on to the T account. T account is the way to record. It's kind of a form of a ledger account used to help illustrate the effects of transaction. We should be remember that a T account is a tool which we used by accountant, and accounts are presented slightly different in our ledger book. So when we see accounts title, on the left it's always been debit, on the right side it's always been credit. But keep in mind, debit are not good or bad, neither as a credit. Debit are not always increasing, and credits are not always decreases. So the debit simply means on the left side, credit simply means on the right side. Okay. Now the accounting equation and the rule of debt and credit. The type of account, assets, liability, owner's equity, that determines how we record increase and decrease. Assets, increase on debt side, decrease on the credit side. Liability and owner's equity is vice versa. If it's increase, we record in our credit side. If it decrease, we record on debit side. Okay, so you can memorize that. And there's examples. So the Alyssa invest $250,000 cash, assets cash increase on the debit side, and then $250,000 increase your liability, owner's equity. Owner's equity. So owner's equity increase on credit side, right? Now $100,000 cash purchase a land, so the land increase as a debit side, so $100,000, and the cash we spend it out will decrease the cash on the credit side. So this is how the business transaction affect your T account. There you go. So this is the form that you want to memorize it, because you will see that debit increase, credit decrease for assets, increase credit, and decrease the credit. Increase onto credit side and decrease onto debit side under liability. Owner's equity, increase investment, go credit side, decrease onto debit side. Owner withdraw the money. If it's increased withdrawal, we go debit side. If it's decreased withdrawal, with the credit side. So this is exactly which is a normal thinking way, right? But for revenue, if it's increased, go credit side. If it's decreased, go debit side. Expenses, vice versa. So this is the rule. When you memorize these rules, it's easier for you to do the journal entry. Now, I want to quickly show you a tutorial video. This is the trick to remember debit and credit. Okay, so that is the trick, and I think it's a very easy way. Oops. So that is, I think, is a very much easier understanding way for students to memorize the debit or credit. If you want to watch it again, you could Google it and just search for tricks for debit and credit. So we'll keep going with this normal balance of account. The normal balance of account is the side used to record increase. An account that has a negative balance, the opposite of its normal balance may indicate that an error has been made. Now we'll move on to our learning objective number 3, analyze and record transactions in journal. Source document. Source document are the raw materials that provide evidence of transactions. Bank deposit slips, which shows amount of money received by the business and deposited into the bank. Purchase invoices, document that tells the business how much to pay and when to pay the vendor. Bank check, document that tells the amount and the date of cash payment. Sales invoices, documents sent to the customer when the business sells goods or services and tells the business how much revenue to record. So those are the examples of source document. Journal entry include. The journal entry include the date of the transaction, the title of the account, debit, and the dollar amount. Title of the account, credit, and the dollar amount. Okay, a short explanation of the transaction. This is all included in your textbook. You can see examples of the journal entry. Now we move on to post from the journal to the ledger. Posting. Posting, the process of transferring data from the journal to the account in the ledger. Debit in the journals are posted as debit to the appropriate account. And credits in the journal are posted as credit to the appropriate account. There's all transactions must be keyed by date or number to link information. So we have this exhibit 2-9 to making a journal entry post to the ledger. This illustrates the flow of accounting information from journalizing the original entry to posting it to the account in ledger. So you can see that our debit or cash, we put it into our cash account on the debit side. And our capital is owner's equity on credit. So we put our Lisa Hunter capital on the credit side. So those are how our different account works. Now we're going to learning objectives. Number, the last one is how can we check if the records are balanced? The trail balance. The trail balance will be, the trail balance is a listing in general ledger order of the debit or credit balance in each account. We could refer to our textbook to see Exhibit 2-12, explain the trail balance. The trail balance is not one of the 4 financial statements, but merely a tool for the accountant. So that is the one we talked about in our last class. The trail balance help you to prepare for your financial statements. Right? You prepare the trail balance first and then move on to the financial statements. So this is how the trail balance looks like. Continue. The trail balance proves whether debit balance in the account equals our credit balance. So you could see that at the very bottom. If there's is not equal to each other, then that means there must be something wrong when you're doing your journal recording or you transfer a number to a trail balance. Some common errors happened. Some common errors happened are like posting incorrectly or mathematical errors. Transposition means digital are written in the wrong order. For example, instead of 567, the number is written as 657. So the number is wrong. Or a transition error is always evenly divided by 9. So you use your wrong number as 6,507 minus the 567, that is correct number, which equals 90, and then you divide by 9. So it's always being helped to identify the slice error. The slice means that one or more zeros are added to or left off. A number 1000 probably we write down as 100. So it's always being evenly divided by 9. So if you're interested on how to find the errors, you could read our textbook. Okay. Now the trail balance, I need to emphasize again, it's a tool used to ensure that the dollar amount of debts equals credit. Proof of this is the fact that in real life, financial statements do not show every account to external users. Rather, they show highly summarized balance of assets, liabilities, and equity. So then why for internal users who prepare the financial statements, you want to have each account listed, which is the trail balance works. So that's it for our chapter 2. Because I'm gonna see you on Friday. So you have Thursday. No, I mean, right? Yeah, you have Wednesday, Thursday to work on your chapter 3. Now we are quickly go through a few questions or like maybe slideshow in chapter 3. There you go. So we're going to talk about a few different accounts and then have a brief introduction. So chapter 3, introduce the concept of adjusting journal entry. So we have NERD, business transaction in our chapter 1. Then we have NERD journal entry ledger books in our chapter 2. Now we move on to chapter 3. You need to do a adjusting journal entry. Okay, why would you need to do a adjusting journal entry, or how are you going to do it? So this is a topic in our chapter 3. Now the first one, apply the recognition criteria for revenue expenses. Accounting cycle. Okay. So time period assumption. The time period assumption ensures that the accounting information is reported at regular intervals, defines the accounting period, and interacts with the revenue and expenses recognition criteria to underline the use of account. The accounting period for most business is 1 year, but accompanying measure is income. Some businesses use calendar year, like January 1st to December 31st, but Other business probably use as a fiscal year. The fiscal year with a year end usually corresponding with a low point in business activity. So they can choose June 31st or August 31st. Everything works, right? Those are for the fiscal year of the business. Interim period. Interim period can be like monthly, quarterly, semi-annually. So it's different type of accounting period. Recognition criteria, revenue recognition. The revenue recognition criteria is one of the most important one that I want you to remember because it's going to go from your whole life. Exactly the same as the double entry rules. The revenue entry criteria state a recognition criteria states that revenue recorded when earned. Revenue is earned in most cases when the business has delivered a complete good or service to the customer. So goods delivered or service completed or contractual agreements have been made. Revenue is earned when the business has delivered a complete good or services to the customer or clients. Many students have difficulty to understand the concepts that revenue recognition is not related to cash. Okay, so I'm trying to give you examples, try to make you understand that. Like Dr. House performed 3 successful surgery during the month of December. The provincial insurance plan was billed a total of $30,000 on December 31st. The doctor did not receive payment for his service until the next year, February. According to the revenue recognition criteria, when should the doctor recognize the revenue? December or February? Think about that question. So the doctor did the surgery on December, but the provincial insurance plan didn't pay him until the next year. When would he gonna record this revenue, recognize the revenue? According to the revenue recognition criteria, we just talked about it. It has to be in December, right? And this is when he performed the surgery or the services. So that is how this revenue recognition criteria works. Now we do have some examples in the recognition criteria for expenses. The matching objectives. The matching objective directs accountants to identify all expenses incurred during the accounting period, measure the expenses and match the expenses against the revenue earned during the period. For example, the cost of product that has been sold, or rent expenses related to a particular month. Expenses with a later link to revenue will be matched against the revenue period. Other expenses, for example, the rent, that are not easily linked with a particular sale will be identified with a particular time period. So those are different situations. Because of this concept, special journal entry, we called adjusting entries, must be recorded to ensure that all revenue and expenses for the accounting period have been properly recorded. So let's move on to our today's major topic in chapter 3, adjusting entries. Accrual basis accounting and cash basis accounting. Accrual basis accounting records the effect of every business transaction as it occurred, no matter when the cash payment occurred. Cash-based accounting recorded transaction only when the cash receipts, cash payments are occurred. So it's really different, right, between those two. But there's very small business use the cash basis accounting. In cash basis accounting, cash receipts are treated as revenue and cash payment are treated as expenses. Very, very few business currently using a cash basis. Now, prepare adjusting entries. Now we have to learning a few accounts. Adjusting entry assign revenue to the period in which they're earned and expenses to the period in which they're incurred. They're needed to measure properly the period's income on the income statements, and bring related assets and liability accounts to correct balance for the balance sheet. The information has been given in our exhibit. Now, we need to bring this up to date. I could give an example of a company that has a profit when using the cash basis, but when you use the accrual basis, the company has a loss. So one such examples could be a party event company. We know that the party event company has a lot of revenue in December because of Christmas parties, but they also have put a lot of expenses on credit, as it doesn't have the cash to pay for the expenses until after it delivers its services. That's if these expenses were not accrued, even though the company won't be paid until January, then you could not probably measure the party events company's true profit, right? Because until December 3rd, expenses happened. You recognize those expenses, but you didn't recognize this revenue until the next year. The business probably is lost the profit. You cannot measure the business profit properly. Now, we're going to talk about a few accounts. Prepaid expenses. Adjusting entries can be divided into prepaid and accrued. We are going to illustrate the prepaid and accrued type adjustment. First is the prepaid expenses. Prepaid expenses are advanced payment of the expenses. They're assets because they represent a potential future economic benefits. That means the cash was paid prior to the good or services being delivered. Example like prepaid insurance, prepaid rent, and supply. We have this prepaid insurance examples. Insurance, we all have this kind of experiences, right? You always purchase your car annual insurances at the beginning of the year. And because you already paid that money, but you haven't actually used those insurances till the time goes by. Now, for example, if you purchase your car insurances on October 1st, and then the company, the ending period will be December 31st, which means October to December, you already used 2-month insurance, but you still have the rest of the 10 months lasted till the next year. Now you have to recognize those 2 months expenses. That's how you're going to prepare your journal entry. So for example, on May 1st, the annual insurance purchased $3,600. Now we'll record the first journal entry, prepaid insurance and credit cash, right? Now after 1 month, we need to make adjusting entry because end of May 31st, 1 month of the insurance has been used, which is $300. We need to debit our insurance expenses, which is expenses happened. And now we have to credit our prepaid insurance. Remember, prepaid insurance, prepaid expenses, we treat it as assets. So prepaid insurance decreased. Now, that is how this prepaid insurance examples, we posted into a T account. So assets, we paid $3,600 on debit side. Now we have been used for 1 month. So on the credit side, $300. Insurance expenses increases, we debit $300 into expenses account. Now we'll move on to the supply examples. Supplies is we purchase supplies $1,500 cash. So we have debit or supplies, credit or cash. Right, on May 31st, we see that we have $1,000 supplies left, which means you used $500. What we need to do, we debit our supply expenses, we credit our supplies to record each supplies being used. Right. Now we move on to supply expenses posting, exactly the same as prepaid expenses. Now, the amortization of property, plant, equipment, and intangible assets. Amortization is the allocation of the cost of the capital assets and except the land, we just talk about that land examples, right? To expenses over its useful life. So amortization is similar to prepaid expenses that an asset is recorded when the plant or equipment is acquired. The asset expenses as it is used, both in kind and substance, are prepaid. The major differences is that prepaid usually expire with a year, while plant equipment assets remain for a number of years. Now we're going to see examples. Amortization examples. On May 3rd, 2019, we purchased furniture for $45,000 with 5 years expected useful life. Now we use straightforward, straight line amortization method. And first, we have to record the purchase rate. So we have our debit, furniture, credit, cash, which is furniture increased $45,000. And assets cash account will decrease $45,000. Now the amortization happened till 1 month. We have 5 years, $9,000 per year. Then per month will be $750. So we record it as amortization expenses, furniture, credit, accumulated amortization, furniture. Now this accumulated amortization is a control account. What is a control account? All right, control account. There you go. So the control account has a accompanying account. Accumulated amortization is control account to the property, plant, equipment assets. We used to show the accumulated sum of all amortization expenses from the date of acquiring the assets. Because when the amortization expenses happened, you could recognize the expenses on debit amortization expenses, but you could not credit the assets, right? Because this is a different expenses account. It's not because the assets revenue decreased. So you cannot do that. Then you have this accumulated amortization account instead of the assets value. That's why we use it. So just remember that, and accumulated amortization account will be used. Now we have T account shows how you record your furniture $45,000 on the debit side. You have your cumulative amortization happened for 1 year. We recorded on $750 on the credit side. Expenses $700 happened for $750. We recorded on the debit side. Now the book value will be the acquisition amount, total value decreased accumulated amortization, and then it equals your net furniture value. I think I have examples. So this is the balance sheet, a partial balance sheet shows. Under this PPE account, you have furnitures as original value amount, and you have the last cumulative amortization. And then you have your net $50,000, which is there's no amortization for net. And you have your total PPE amount. Okay. Now the last one is unearned revenue. Unearned revenue, which means you already received the money, but you haven't provided your service yet. So unearned revenue is a liability. We have talked about this in our first class. So for example, if you are a cater company, so you are providing the catering services for the business. Now you receive the money from one company saying that they want you to do a catering services next month. So you receive their money, but you haven't delivered your food yet. Okay, so that is unearned revenue, and you need to record this unearned revenue under your liability account. We can see examples. So HEC received a cash advance $3,000 on May 20th, and for a customer for 30 days project. Now we record it. We have our cash received already. Now we record it unearned service revenue. This is liability increase, so we put it into credit side. Now, during the last 10 days of the month, the HEC earned 1/3 of $3,000. So the $1,000 has been earned. Okay, we already delivered a partial of the project. So we received the real, we need to recognize those unearned revenue, $1,000. Now our unearned revenue decreased $1,000 because its liability decreased, and our service revenue increased. We put onto credit. This is $1,000. So this is how this adjusting entry shows at end of the period. Now we put into the same T account. We have unearned services, $3,000 we recorded. Now we have $1,000 to be recognized. So we put on the debit side. We still have $2,000 under the liability, right? Now the service revenue, $24,000. We have our $1,500, and May 31st, we recognize $1,000. So the balance will still be $26,500. Now, accrued expenses. This is the last part, I believe, before you keep going. So accrued expenses are expenses that are incurred by the end of the period but not being paid until a later period. Very normal examples like salary. So if you work till December 31st, the last day, but the company's payday will be January the 5th. So for the point of the company's view, this salary payable will be accrued expenses as salary expenses. So examples, salary expenses. See, 2 employees bi-weekly month salary $4,000 on the 15th of the last day of the month are paid on May 15th, but May 31st is Saturday. So they will have to get paid on June the 2nd. Now on May the 31st, you still need to recognize these expenses because it's happened, even though you haven't paid yet. So that is a accrued expenses. Now we record it as debit of salary expenses, $4,000. Now our liability will increase $4,000 as salary payable because we haven't paid yet, right? We owe the money to those employees. Now, after posting, the payment on June 2nd does not affect May or June expenses because the May expenses were recorded on May 15th and May 31st. Now, when you see the T accounts on May 31st, salary expenses increased $4,000, liability increased $4,000. Accrued expenses examples, salary, future payment of accrued salary. Now, the next month, June the 2nd, the company finally made a payment to the 2 employees. We need to record the payment. Our cash decreased $4,000, salary payable decreased. We go to debit because it's liability decreased $4,000. Okay. Oh, I still have one more, accrued revenue. Sorry. Now, so accrued revenue is defined as revenue has been earned but not yet invoiced or connected. So because it's earned already, we need to recognize. So let's see examples. HEC hired on May 15th to provide monthly service for $3,000 per month with the first payment to be received on June 15th. Service is provided from May 15th to May 30th. Now adjusting entry on May 30th to record those 2 weeks of revenue. We debit our accounts receivable, credit service revenue. Now when the end, all accrued revenue are accounted for similarly. We could see account receivable on the debit side, $1,500, and revenue on the right side. So the 2 rules to remember of adjusting entries. First, adjusting entries never involve the cash account. Adjusting entries either increase a revenue account or increase an expenses account. Okay, so that's basically for today. Now, Friday we'll keep moving with chapter 3 and also chapter 4. Okay. If you have any questions, send me an email so we can talk about it in the next section.